Hi everyone. My name is Loutsenko, founder and CEO of OVOM Research. Just dressed a little more casual since it's Sunday, but I wanted to take what I hope will be just a few minutes to talk about the equity market. Um, because I guess after I just finished my monthly June markets update. I try to think a lot about like um what the opposing narrative to mine is, and what their logic is behind that really. Um, so I could really, I guess, get a sense of if I'm too biased maybe, or if there's something that I'm not thinking about that others are, that's correct, and how that could benefit me. So that's what I wanted to start this quick presentation with. But then I wanted to share, I guess, more. So let me just start. Uh, okay. So this is the 2024 year-to-date performance of major US equity market indices. And so what I started, saying with respect to thinking about the thought process of people who have a different opinion than me on the US equity market, this is what I was talking about. So as you can see, the Nasdaq 100 and market-weighted S&P 500 are greatly outperforming the other major U.S. equity market indices, and that's very typical of what we saw in all of 2023. So, I could see why a lot of investors in excuse me, in the U.S. equity market are thinking, you know, we we're basically seeing an extension of 2023, and there's no reason that we shouldn't just continue to see that extension of 2023 in the first half of 2024 continue into the second. And in the second part of this, I'll get to why I think that maybe that won't happen. But yeah, for now, I guess my bottom line here is that I definitely understand where bulls on big tech and US large caps are coming from. You know, and with respect to the 2024 year-to-date performance through June 1st, of the S&P 500 and the 11 market segments that make it up. Utilities are having, a good year. They're almost outperforming the S&P 500 composite, but again, it's being led by communications and technology, which, led in 2023 as well. So again, really the same point as the last slide. Yeah, and on excuse me, on a monthly basis. So at the very end, actually looks like this was on May 30th. So this was before the last trading day where tech forgot if I believe tech fell even more, but yeah, utilities aside, technology and communications went on a monthly basis as well. But looking a little bit beneath the surface of kind of the segment level and index level performance, the Magnificent Seven still comprise the lion's share of the weight in the respective ETFs that are leading the market. So XOK, obviously, Apple and Microsoft now, and NVIDIA controls a very, very sizable number, number three percentage in that ETF. And then, XLC, you have Meta and Google Class A and Class C shares that are controlling, the lion's share of that. And then XLY consumer discretionary has fallen off this year because of Tesla's performance, but Amazon's included in that as well. And I say that to say that um, really the markets, it we know that it's already it's already kind of transitioned from the Magnificent Seven to the Fabulous Four, because three of these stocks, Microsoft, Apple, and Tesla, are underperforming the S&P 500 composite. And it looks like, to me personally, Amazon's, even in the short term, potentially going down. Certainly in the long term, but I'll leave that for the second part of this. But really, as this chart demonstrates, even Meta, who's up almost 36% year to date, and that is very exciting. But it really it is, frankly, it's a story about Nvidia. I wouldn't say the whole, obviously S&P 500 or NASDAQ 100 is about Nvidia, but I think that market leadership basically has come down to the Nvidia AI semi space rather than broader US large cap tech even. And that's what I wanted to get to on this slide. Late in the week, we saw Salesforce beat EPS estimates but miss on revenues, and they got punished. They're the black line here. So this was when they missed revenues at the very end of May. I believe their share price went down something like 30% drawdown in after hours after they had missed revenues, and they got some of that back. But if names like Salesforce, Adobe's down 24% year to date, Etsy's had their continuing challenges. We already know Tesla, Intel's down 36%. They were supposed to be in the semi-competitor space. So if some of the exciting semiconductor stocks aren't part of the broader U.S. Large cap tech rally, and some of this hallmarks of that ETF, Salesforce, aren't participating either, I think that's more signs of an overly concentrated market, and B, that presents inherently more market risk to what now, you could see Micron's up over 50% year to date, and obviously Nvidia is more than double that. But it's essentially the Nvidia market, because even AMD and Broadcom, you can see here, are both up above about 20% year to date. But that's below Google and Meta. So it's now become really a question of, do you want the exciting semi kind of AI stocks, or do you just want mega cap tech? And I think a lot of people are deciding that they just want mega cap tech. So I think we'll see this rally in semis start to, well, sorry, it's already started to fade. I mean, look at ON Semiconductor down almost 13%, year to date, but Cisco was supposed to come back down 7% year to date. But I think we're going to see a lot more of those speculative large cap tech names go down, and the late cycle equity market rally is going to be down to a few mega cap tech stocks. And before I get to what I think will ultimately happen with them, I actually wanted to touch on Nvidia specifically. So oftentimes, I say they're a stock with historically cyclical fundamentals, and this is what I mean, and this kind of proves it. So the red bars represent annual revenue growth. You can see 2010, 2011, 2012, 2013. very cyclical, 2014, 2015, 2016, 2017, 2018, 2019. Again, very, very cyclical. Even during a secular, bull market in the broader U.S. equity market, small caps and large caps, all segments participating. Those are the definition of cyclical fundamentals, the annual revenue growth. And again, we saw it 2019 through 2022. Yes, they've had an excellent 2023, but even in 2024, yes, again, their fundamentals have they've been excellent, but they haven't exactly been to the point of where they should be to reflect NVIDIA's share price. So an example of that is like this year, NVIDIA's up 122% year to date, but the annual consensus revenue growth estimate is 83% right now. It's come down to 2% in the last week. So, year up to 122% year to date, but annual revenue growth, through 5 months, but annual revenue growth of 83%, that's still overpriced. But, again, their historic annual revenue growth during a secular, a non-debated secular bull market in U.S. equities, the cyclicality of their revenue growth, annual revenues, I think, speaks a lot to what we should expect their long-term, fair market value share price to be. And again, I would very strongly suggest that it's currently overpriced. So I guess I have a couple quick charts before I get to my point about why I think it's going to be different with respect to 2023 and the first half of 2024. But this to me proves that there have been times in history where that we've had similar kind of market cap concentration to what we have today, and we have historic examples of what happens in situations like the one we're in today. We've only seen it, at the peak preceding the Great Depression and the peak preceding the tech bust. But this is the top 10. The top 10 market cap, the market cap of the top 10 stocks relative to the total U.S. stock market. So you can see the median, long-term medians around 63, 64%. We're at about 74% right now. And historically, when that happens, this ratio drops. So again, the ratio of the top 10 market stocks by market cap, total market capitalization relative to the total U.S. stock market, meaning that there is a drawdown in those 10 stocks and market broadens out in terms of concentration. So this is another way that to show that concentrations really increase to what I think is going to be an unsustainable level, and that's really only part of why I think the second half of this potentially 2024, certainly 2025, that will be very different than 2023 in the first half of 2024. But here we could see the ratio of the equal weight S&P 500 to the market cap weighted S&P 500. So for the ratio to be so lopsided towards the market cap weighted S&P 500, you have to think that it's being led by a very small group of stocks that control the market, and that's exactly what's happening. But what's interesting about that is the current ratio is the same as when the secular bull market post the GFC kind of began. So, here's 2008 and 2009's out here. So Lehman already collapsed back at, here. But I think this is probably Lehman's collapse. So the secular bull market, when people say began in April of 2009. Some people say, I've heard people say February, but a lot of people agree it was April of 2009. So that's right around where the current ratio is. So some people, take this to mean that we're, I'm sorry, I've seen people's reactions to, charts like these saying that, oh, we've reached a level of resistance here. So, that means we must be starting a secular bull market. And for that to be the case, the market rally would have to broaden, but that's not what we're seeing, and that's not what investors are thinking. They're thinking they're safe in mega cap tech. The Russell 2000, we saw it in the first chart. Russell 2000, the Dow Jones, the equal weight S&P 500. They've had, investors have had very little interest in those areas of the market relative to the, Nasdaq 100, big cap tech, and the S&P 500 market weighted index, which is again driven by a monopolistic tech, the Magnificent Seven mega caps. So again, another way that I believe this shows overconcentration in the U.S. equity market. But again, I frankly, I don't understand why people would consider this signs of that we're about to see a broadening out of the market. But I guess I've been wrong about some things, so I understand that everyone has a point of view, and sometimes it's not the correct one. So this chart just shows really, I guess, this the essentially. So I think that in the second half of 2024, or if it doesn't happen in the second half of 2024, the first half of 2025, U.S. economy is going to see severe deflation leading to recession, more than what the Fed expects, because the Fed isn't factoring in the lagged impact of rate hikes. But this chart, I just made because on Friday, we got the Chicago PMI, and we're going to get the ISM manufacturing PMI this coming week. But really, I made it to start to speak about the macro angle that not a lot of market participants are in equities, in my view, are thinking about. But on Friday, we saw the Chicago regional PMI plunge further to 35.4, and consensus is looking for somewhere in the 40s again. So economic consensus, to be clear. Not taking a shot or anything like that. I'm just matter of factly saying consensus estimated 44 point something when it dropped down to 37.8 before falling to 35.4. They were again looking for something in the 40s. I'm positive, but I'm not exact. I don't remember the exact numbers, so I want to make a guess. But that's just to say that not only is the Fed underestimating the lagged impact of rate hikes in this cycle, but economic consensus seems to be missing it as well. At least some people in economic consensus. But historically, the regional Chicago PMI appears to lead the broader ISM manufacturing PMI. So I think we will see a miss, if not coming week, certainly in the next month and coming months of this year. So just using the chart to demonstrate that I think that we are underestimating the lagged impact that rate hikes will lead to severe deflation in the U.S. economy, ultimately dropping economic growth down into recession into a U.S. recession. And that's also supported by the first quarter of 2024 annualized real U.S. GDP growth on a quarterly basis. So, excuse me, everyone's been pointing to the second quarter Atlanta Fed nowcast model, which, by the way, on Friday dropped down from 3.4% to 2.7, 2.8%, either, no, 2.7%, I believe, on Friday, the same estimate that it had the day before we got the first official estimate of first quarter US GDP growth. So the Atlanta Fed's model had it at 2.7. First estimate right after that was at the very end of April. The Atlanta Fed, their last reading of the nowcast model for the first quarter was April 24th. It was 2.7%. So, day after that, we get 1.6%. First revision just was on Wednesday or Thursday this week. Sorry, I believe Wednesday. It was the April estimate was revised down to 1.3% quarterly growth, which is below the long-term average of about 2 to 2.2%. For the U.S. economy. That's, when I say long-term average, I mean for more than a century. So to me, this is a sign that we are seeing more deflation, even in the, data, not just leading indicators of where economic growth is, but actual, economic growth, literal U.S. real GDP, is coming in significantly lower than the Fed and consensus are anticipating. And again, the Atlanta Fed's nowcast model, I don't know if, we'll see how much talk there is about it this week since it dropped pretty significantly Friday, but with rates still higher for longer, I don't understand why we would expect a increase in economic growth unless it was short term due to layoffs, which will send us into a recession via the labor market, and the labor market's the only thing holding the U.S. economy together right now. So either way, I think, like I said, we're going to see too much deflation at the macro level, and it's going to drive economic growth down into a U.S. recession, and that's not being priced in by the market, by the U.S. equity market at all right now. Nvidia's 70 times earnings, price to earnings multiple. People are saying they've grown into their valuation. They're still long-term bullish on Nvidia, even with those cyclical fundamentals that I showed. So, in an economic downturn, the sell-off is, in my view, going to be pretty drastic. But this is also, if you kind of follow the macro data, that all the regional feds have been, and the Chairman Powell and the U.S. Fed haven't said it in I don't, to my knowledge, publicly, but all the regional feds are using the 10-year 3-month yields curve in their recession models in this cycle versus the 10-year 2-year yields curve spread, which is traditional. But I think I've explained why that is before. But one of the reasons that I think it makes more sense, having seen that they're using it, is it's way more accurate at predicting recession. It didn't invert in the mid 90s like the 10-year 2-year spread did. and I believe it might have before, in 1962 or something, when there was no landing, as well, and in early 90s, 1960s, early to mid 1960s on the cycle. But anyway, the 10-year, 3-month yield curve spread didn't invert there either. The only time it inverted before 1968, I believe, is the before the Great Depression. So it's nailed every recession, and it remains inverted in this cycle, and having reached a max inversion of I think 281% in this cycle, it's hard not to see a recession. But again, if you're looking at the market from a macro perspective, I thought this would be an interesting slide. So this is the S&P 500 drawdown. Every time the yields curve's been 10-year, 3-month yields curve's been inverted, plotted against the number of consecutive days of 10-year, 3-month yields curve inversion. So May 31st, the last trading and actual last day of May, before we start June on Monday, was inverted 543 days. So now longer than the 540 days it was inverted preceding the Great Depression. And history, suggests the longer the 10-year, the 3-month yields curves inverted, the more severe the peak to trough drawdown for the S&P 500 is. So, if we're following a very loosely correlated, with the correlation coefficient, it's one variable, but 73%, not that. I mean, it would be if there were more variables in this model, but I wouldn't take the 3% correlation coefficient too seriously here. But theoretically, if we were to look at this trend, we'd be looking at about a 60% drawdown right now for the S&P 500. So I thought that was interesting to share. Before I finish out this video just by talking about my asset allocation reasoning in the S&P 500, but mostly I wanted to talk about the asset allocation using the OVMO all-weather framework, which I'll share again after this slide. But really, I just prefaced that with this to show that there really are better options than what at this point are extremely risky or extremely underpriced risk mega cap tech stocks. You can see here, this is indexed at 100, the first trading day of 2024. Silver, gold miners, gold, all outperforming the S&P 500 composite. Emerging markets haven't done great the past month, but they're not too far behind. But in my view, what I pointed out before in this chart when I shared it, I think broader commodities are still underpriced for what I think the long-term macro picture is. So yeah, I think there are better options even in the short and long, certainly the long term, than mega cap tech. And admittedly, a lot of investors disagree right now, but the year-to-date performance of these ETFs shows that there are quite a few that do agree, but I think more of the ones that don't will start to come along, and areas that here we're already seeing outperform U.S. equity market indices broadly will just continue to do so. But let me get to the last slide here, which is just my asset allocation weightings for S&P 500 segments, and then the OVMO all-weather strategy, which I will get to second. So nothing changed about the way we're looking at the S&P 500. Really any month since we started doing this in April. Um, no, I'll just go through quickly. Real estate had a good month, but that's actually a great example of something where you can discount like a monthly data point pretty much because it's the only it's the worst performing segment on a year-to-date basis and since 2023 by far. We've been underweight because higher interest rates adversely impact real estate, and there are other, broader reasons as well, but we were, it's not certainly not a segment that's exciting anyone. So we have been underweight, remain underweight, and yeah, it had a good month relative to some other segments, but there's not much to be excited about in S&P 500, real rights right now. No, we remain overweight on utilities for the reasons that we had mentioned before. Neutral on consumer staples, but as soon as we see rate cuts, we would move to above average or overweight there. Um, we are still underweight on financials. And I think we've mentioned the reasons before. We aren't bullish about an ongoing banking crisis where Chairman Powell said verbatim that he is sure there will be more banking failures following Stephen Mnuchin, sorry, his last name to pronounce Mnuchin's private equity firm buying out NYCB's balance sheet. So we're just awaiting those, and I don't think those will be bullish for large cap financials, but nor will the deflation that results in an economic recession. But we'll see. We're not exactly getting that one right just yet. Neutral on industrials, above average on materials because really materials is the only S&P 500 segment that gives you any exposure at all to like precious metals and commodities. Like 5-6%, something like 6% of that ETF is comprised of what ultimately is, like I said, precious metals and commodities. So we're a little bit above average. And we also like valuations that are similar to other segments that we're not underweight on, but yeah. So we're sticking with below average on energy. Again, I mentioned this a lot, but we expect further deflation, and energy is a cyclical where demand more often than not drives the price. Sometimes it is supply, but typically in a deflationary environment, energy is a bad segment to own because the demand for energy products just goes down because consumers can't afford to pay. They can only afford to pay less. So and we're seeing robust global supply right now anyway. So we don't expect crude oil to rise, and really that's a good kind of indicator of broader energy. Usually, at least the S&P 500 energy ETF. So yeah, we remain pretty bearish on energy. Healthcare, neutral. Historically, it's been a growth segment. Not sure if it's at least it's non-cyclical historically, so we're not underweight, even though we'd like to see performance a little higher than it is now. But we remain neutral. We don't think it's something to necessarily sell if you own it. Again, we're underweight on consumer discretionary, so we expect deflation, and consumer discretionary, some people refer to it as consumer cyclicals. So they're cyclicals. They don't do well in deflation when demand's down. So we remain underweight. However, we are overweight on communications and stay overweight because we like the fundamentals of the mega caps that are driving performance in that ETF. And we like the non-cyclicality of many of the um, communication stocks in that ETF. So, until we see, very material economic disappointment that is blatantly obvious for the rest of the equity market, we think communications will do well. This is really the big one, info tech. We're gonna stay underweight because the risk reward for us isn't worth like that's part of it. We think there are other areas of even the S&P 500 that are much more interesting than infotech right now. The valuations really are the I don't want to say they're absurd. They're historically very, very elevated relative to history. It's being led by either stocks like Apple where, we've already seen fundamental deterioration, just not impacting their share price yet because the market's been largely trading on interest rates, not fundamentals like earnings and revenues, even though we're starting to see more of that. And because we're starting to see more of that, I think that's a good reason to stay underweight. Because of the inevitability when the market begins to trade on earnings, it's going to be I've said this before, but I think it'll be kind of like stairs up and elevator down situation for the overpriced mega caps that are in XLK. I specifically think Nvidia's overpriced. I think Apple is definitely overpriced. I don't even view Apple. I know they're in XLK, but I view them as a consumer cyclical. I I mean, I guess they're now entering the AI space with the iPhone 18, even though I've seen the most bullish analysts on Apple before that say, it'll be a nightmare scenario for their stock if they do that. They made fun of them about like building robots, but I guess they're entering the AI space, but they've had like revenue growth. I mean, either year over year revenue growth, either like barely positive or, negative for 6 straight quarters or something like that. Their fundamentals have not been impressive. Yeah, their share buybacks have always been impressive. I mean, they had the largest one in history, and that caused their stock to partially recover. But in the long term, we definitely view them as still overpriced, frankly. Um, and Microsoft, it's a great company, but it's the most expensive in the world. We think all the growth is priced in, and future growth. So um, we don't see we don't see the upside in staying in InfoCap tech at this time, given the other options, and we see a lot of downside staying in InfoCap tech. Um, sorry, large cap info tech. If the market begins to trade on earnings. So yeah, I know that that's like a very unpopular opinion now, but and we haven't been exactly right about it yet. Like like I said, I think in the future we will be. So lastly, just finishing out with the all-weather asset allocation, the OVOM all-weather asset allocation strategy. So just to start, I mean, we we built a systematic approach to asset allocation based on the all-weather framework. Um, we made some new changes to ours, but it it inherently you have to allocate some portion of your portfolio to equities, fixed income, and commodities. We included a small percentage for unique ideas, but that's to say that we understand that there aren't, a lot or any benefit to the U.S. fixed income market right now for many reasons. Some very obvious, but this asset allocation strategy is based on a systematic approach. Um, and 30% fixed income is the lowest possible asset allocation to fixed income that the model allows for. So yeah, I guess I wanted to start with saying, the times when this asset allocation strategy will outperform is it's expected to for the longer, duration for the long-term investors. Um, because we're not there's no systematic approach. It's going to allocate, all of the portfolio to NVIDIA or something, or even the S&P 500. So we aren't going to be beating the, during times of, especially financial asset valuation imbalances, we're not going to be outperforming the, large cap growth areas of equity markets or things like that. But the broader idea, like I said, it's for those who know the all-weather framework. It's built for to outperform over the long run through all kinds of market conditions. But in the short term, it has its flaws, so to speak. But anyway, going into our strategies in detail, we are, excuse me, we're allocating 35% to U.S. equities. So we like communication and technology and utilities, like we said in the S&P 500. But really broadly, we like to allocate the majority of the weight, like in U.S. equities, to an index that's gonna perform the I guess the most in line with how the U.S. equity market's performing, and we view that as the Nasdaq Composite. But could also be like the Vanguard Total Stock Market Index. We just again we have the Nasdaq Composite ETF in our model, but I'm sure others would do something similar. Would use maybe something like I said, Vanguard's Total Stock Market Index. I think that's what the unofficial weather framework uses, but anyway, moving on to fixed income. So we see deflation. That's why, we see in the more immediate term, actually, leading indicators show stagflation, then moving to deflation. So that calls for allocating in fixed income to TIPS, and we also allocated small parts of the U.S. aggregate bond market. Because again, we want to be at least at a minimal amount broadly exposed to the U.S. bond market, because just historically, in the long term, it's beneficial to be, I guess, to put it in short. So moving on to commodities, and again, those are U.S. fixed income ETFs are the ones that are underperforming. We know that is going to happen. So I guess good question is like, why invest in something even in the near term if it's not doing well, and you don't see a positive outlook for it? And our response would just be that that's what the systematic model kind of calls for. And again, in the long term, um, we see a lot of benefits of that approach. But moving on to commodities, so we're allocating 30%, I believe, yeah, right now to commodities, which again is either the maximum or the very close to the maximum that our version of the all-weather strategy calls for. But like this Ray Dalio's all-weather framework, we allocate the majority to physical gold via the gold ETF, GLD. And we, as we've spoken about in other videos, we see silver and miners as the two most underpriced growth. Even, we refer to them as like growth areas of commodities. Historically, they, during precious metals bull markets, they've grown quite a bit. And again, we think they're underpriced. Those are the two largest potential growth areas that are the cheapest right now in the precious metals and commodity space, in our view. And just unique ideas. This is very little asset allocation relative to the total portfolio weight, but we like Google for reasons that we've mentioned a bunch now. And 2.5% to the MSCI USA Quality Factor Index, which our research shows in terms of U.S. equity market exposure, it does pretty okay in deflationary environments, which, as we've reiterated, we expect in the long term. So yeah, that's all we have. Hope everyone's enjoying their weekend, and best of luck to everyone in the coming week and month of, for those of us participating in U.S. equities or any broader global financial market participants.